Sounds great.
Okay.
And Roman, would you mind maybe just a quick intro to who the group is a little bit?
For sure. So I guess for context, I am an analyst for HUCP, which is an undergraduate venture capital program that's here on campus. In terms of the people who are attending today, obviously there are people who will watch the recording afterwards, but it's a mix of people who are participants in the club, so they're analysts or they're in leadership positions with HUCP, or in kind of what this entire boot camp is centered around is the people who are part of the 2020 cohort of our innovation fund. So we gave out about $15,000 in grants to companies that have some relationship to Harvard. And a lot of those founders are here today. And I'm sure they'll have great questions to ask you as both like an operative and as an investor.
Great.
So I just wanted to start off by introducing a little bit about yourself. So I'm very pleased to introduce Ben Gilbert today as the final Fireside Chat of the 2020 Innovation Fund Bootcamp. And I'm very, very thankful for him giving some of his time today. I just sent him a cold email and I was very happy to get a response and for his involvement in this process. I wanted to touch a little bit on some background about Ben so that can kind of guide questions and where this discussion goes. So he's been involved in the startup world from all angles. He co-founded Functional Delights in 2009, creating 2 iPhone applications just during the infancy of the mobile boom, which accrued over 1 million downloads. At Microsoft, he shipped the first version of Office for iPad and ran The Garage, which was the company's grassroots innovation program. And today, among a lot of other things, he is the co-founder of Pioneer Square Labs, a startup studio and early stage VC fund that's based in Seattle, as well as the co-host of the podcast Acquired, which is how I learned about him and how some of you may also know him. So Ben, thank you also very much for being with us today. We're very grateful for your time.
Happy to be here. Thanks for, I love a good cold email. I think they work way better than their reputation, and happy to be on the receiving end of one.
Great. So in terms of structure, the way we've been doing these in the past is about 40 minutes. I guess some of the intro time has gotten into that. So at about 6:40 Eastern time, we're going to transition to questions from the audience that are either specific to the companies they're starting or just kind of generally about things that we talked about. But I wanted to start the discussion a little bit talking about your involvement with Pioneer Square Labs, which I mentioned a little bit in the intro. And my biggest question is kind of as an entrepreneur who transitioned to venture capital kind of later in your career, what have you learned from being on the investor side of the equation? And kind of what did you wish that you knew when you were starting off in the entrepreneurial end, when you saw what's behind the curtain, so to speak?
Yeah, it's a great question. You know, we're obsessed at Pioneer Square Labs with the idea of validating a startup idea. I think when I was first doing iPhone apps in 2009, 10, and into some of my sort of more bootstrap startups in 2012 and 13, that was the era of the MVP, where the common wisdom was ship it, get it out there, get market feedback. And we have such robust tooling. You could say no code or low code, but just every SaaS application has gotten to the point where there's this really robust ecosystem of ways to test concepts without actually investing months in building something and getting it out there and seeing. And we can get feedback much faster now. And so in the studio, we're just so obsessed with this idea of how quickly can we get signal on whether the market wants this idea or not. And, you know, I always thought when I was an entrepreneur, or I guess I still am, but when I was sort of like an indie developer, it made me feel really good when VCs would say, look, we invest in people, and you know, good people find their way to good ideas. And that's absolutely true. But there is no amount of good infrastructure in your company, or like the right people, or being super buttoned up, or behaving like a company that make a business successful. It's a creative insight that you have being validated by customers who say, oh, I love this thing. Like, you actually create something that is a unique and magical experience that they haven't been able to have before. That is the ticket of admission of being a company. and being one that's successful. And there's often a lot of window dressing, having a nice website and building a Twitter following and hiring people. And a lot of this is sort of like veneer around what really is the core thing that makes a company work, which is like customers being like, this is the best thing ever. And I can't believe someone finally made this for me.
Mm. And what are those leading indicators that you look for? Is it really just hearing that excitement in customers' voices or those stories, or is it kind of some kind of KPI that's like magical that you look for?
Well, it's different, I think, in B2B versus B2C. And then you can branch down in different types of verticals within each one of those too. But the best thing about B2B is it's literally someone paying you. Like if someone wants something bad enough, they'll pay you before you make it. So that's hard to do, but that is like getting dollars for a clear communication of what an idea will be is an amazing and pretty objective form of validation. There's lots of ways to walk a step or two or back from that. Like you could do a signed LOI, a letter of intent that's non-binding, but signals that someone is intending to make a line item in their budget for you. There's I think the rise of Kickstarter and other sort of methods of crowdfunding in consumer land is a great way to validate that there's a market for something based on the hype you can create for it. I don't want to overpaint the picture that you can do this with any type of business, because I do think there's lots of businesses like games or like consumer social apps where any given minute interaction can make or break the experience in a fundamental way, where it is still the era of the MVP and you do actually have to go out and build a lot of it. No one's got a feature checklist for what will be the next TikTok that is going to work in a user interview for someone to tell you like, oh yeah, no, when I swipe up, I like it to go to the next video, therefore it's going to be a successful business. Like you just can't get that in that type of business model. But for ones where you're building for a vertical, you're going to build a business, you know what budget it's going to come out of, getting someone to pay for something is an incredible form of validation. If you can't get there, a lot of the times we will do a lot in the way of standing up a landing page that describes what the opportunity or describes what the offering will be, and then gauging demand of how people interact with the page and compare it to other benchmarks we have from the other 250 ideas that we've killed over time to see, are the click-through rates higher or lower than they should be? Do people linger on site longer? How do people behave when they add something to their cart? There's just ways that you can sort of comp that against benchmarks and figure out before we actually build something, is this more or less compelling?
I wanted to touch a little bit on, and I mentioned this in the introduction when I was explaining that Pioneer Square Labs is both, a traditional VC firm, but also has a startup studio. And I was hoping you could explain what it means to be a startup studio, kind of how new that model is, what types of value it provides to startups, and why you chose to start one.
Yeah, absolutely. So that's a good call out, and I should have explained it too. We have two businesses under one brand. One is the PSL Studio and one is PSL Ventures. PSL Ventures is an $80 million, I'll explain that first just because it's easier, $80 million seed stage fund focused on the Pacific Northwest that invests both in the companies started in the studio and in companies that are started the traditional way, which is going to be the vast majority of companies for, I think, an extended period of time. Like I love the startup studio model. I think it's a no-brainer in lots of situations. However, when I look back at, we're very proud of this stat. 13% of the companies that went on to become venture funded that were started in Washington, in the Seattle area in the last couple of years, were started out of our studio. So like big chunk of the companies that go on to raise VC money and hopefully get big started in this way. The vast majority still started the normal way, and lots of people still should do that. And so I want to paint the picture that like, I'm not at all saying the startup studio is the only way to start companies in the future. That said, why I'm so excited about the model is for decades, no one has ever created economies of scale out of the actions that you have to take when you're starting a company. There's a lot of stuff, even if companies are pretty different, where this is why serial entrepreneurship is awesome. After you go through it once, it's just way easier the second time. But most people, like the average number of companies that an entrepreneur will start in their lifetime on average is like 1.1. Like most people don't get a second, third, fourth shot at it. Those are the crazy people. And so this sort of pulls forward a lot of those learnings to the first time that someone's starting a company. And that can be anything sort of operational, administrative around like company formation and how you divide up your cap table and that sort of things. But it's also a lot of the really tactical stuff of like, what's the right stack that I should use between my digital product and my marketing landing page to make sure that the two are talking to each other well. So I have clean metrics from day one, where I don't have this like lossy bit of information where I can only describe when I'm getting ready to go do a fundraise. I'm not just describing the most recent 2 months when I've got my act together. I know since I started the company how all my customers have been behaving. Another sort of way that the studio model is really helpful when you're starting a company is A+ team from day one. So when you're starting a company, you don't really deserve any resources because the company is pathetic. It's not capitalized. It's one person. It's just an idea. There's no customers. There's no partners. Like, why should anybody give that thing money? Why should anybody stake their career on it and jump ship and go join your thing? And it's through sort of the compelling personality of amazing entrepreneurs that they're able to pull forward resources that their company doesn't deserve yet, which then becomes a snowball effect. And it's a self-fulfilling prophecy where then they do deserve the next resource because now they're a more real entity in the world that is able to sort of have more impact. And one thing that's cool about the studio is, or at least ours, is this 22-person team. We have 6 engineers on staff who have all been former founders or CTOs before. This like amazing design team, awesome growth marketing people, a data scientist who used to be a PhD researcher. And so the idea is like every startup is started with this crack team of like amazing at their given discipline people who can roll on and off your project. And the idea is that they join your project. So even though your company's not deserving yet of you recruiting the smartest people to join it, they can kind of keep it going and make early progress so that you can get to market that much faster before you start pulling in all the resources that you will eventually have at your disposal. And so that's kind of my mental framework for it, is it just pulls forward a lot of stuff that you hopefully would get to do later.
One thing when I was kind of going through the PSL website and kind of the explanation of the value that you provide to companies, one thing that struck me was how you think of the process iteratively. When you have such a large batch of companies, it's just easier to run simulations, figure out where resources should go, and kind of triage in that way. And I guess the numbers that it has on the website are, 24 ideas were spun out of, it seems like the cohort or, whoever was in the Washington studio, and then 193 ideas were killed. And the question that I wanted to ask was, obviously killing a company is a really tough decision, one that I think that if you're not in a studio and you kind of have easy other things that you can jump towards, it's like that's a very personal decision to make. So when you're kind of being honest with yourself about in what circumstances you kill a company, what goes into that decision? And I'm sure after doing it hundreds of times, you kind of have a good methodology, and I'd just be really interested to hear that.
Yeah, well, the hardest part of doing this is the interpersonal components. Like, having a great process for a startup studio is necessary, but not sufficient in order to make it work. The thing that makes it work is 100% the human element, 100% the relationships you have with top entrepreneurs who you're dying to pull in and work with in some way, the relationships that you have with downstream capital providers who are going to invest in these companies based on your reputation and the idea that you're saying, hey, I went through our studio process and this person's amazing and the results are promising, but early. So you're making a bet based on sort of a reputation here. So there's just so much to it that is about people and relationships and emotion that, yes, you need to have a great process. Like the whole thing would fall apart if you weren't able to come up with great ideas and move them to the next set of stages. But I think I think many studios have failed over the years where people think that that's what it's all about, that that's sort of the competency of the studio that makes it a success. So with that being the groundwork, I'll say that the personality type of someone who's able to pull off a studio is someone who is both dispassionate and passionate at the same time. And what I mean by that is you have to be dispassionate enough to kill ideas, and be ruthless about that, because the people who are on this team are crazy expensive. So every day that you let something live on, if there's like 3 people on that project, thousands of dollars you're flushing down the drain. If in your heart you know it's dead, but you're allowing it to continue existing. But passionate because, like, entrepreneurship's not a science. You need to irrationally believe in something. You need to be a contrarian in order to, like, birth it into the world, because if people aren't skeptical of it, and your passion isn't the thing that's pushing it through, then all the potential upside is already arbitraged away, because everybody already believes it's a good idea and some big company should have already done it. And so that's what I mean by this sort of like dispassionate and passionate at the same time. And so that means that whenever we're working with an entrepreneur, you have to be crazy honest up front about where you are in the process. Yeah, how far along is this thing? And I'll talk about the stages here in a second. But like, hey, you should take a risk on us and join this thing and make way less money than you were. Also, we could kill this thing at any given point. Like, it's kind of it's a hard thing to pitch someone who has lots of other great options. But if someone really wants to start a company, that actually is how they should think about it too. Because the scarce resource, of course, our people are expensive and the studio has overhead and all that. But the scarce resource, if you're working with the right people, is actually their time. And they should want to kill it as soon as possible if it's not going to work, so that they can get on to the next thing. Like, they shouldn't value the safety and security of getting to incubate something and kind of keep pushing it forward if they also in their hearts know this isn't going to be a huge opportunity for me. So I will say that, like, oftentimes that tricky conversation up front forces people to go, what? That is not an attractive value prop to me. But it's actually an interesting litmus test for working with the right people. So we're not afraid to have that early conversation. The way that we divide up the stages is it's a 5-stage process. Of course, it's arbitrary and you can assign any number of stages to it, but the number we picked was 5. We call them, sorry about that. We call them ideation, validation, creation, spin out, scale up. And the important thing to note there is that our creation phase, that's where we do dev and design and all that, happens after validation. We aggressively try to not staff a project with developers and designers. Again, no longer really the era of the MVP until after we have some positive signal from customers that we should go and build that thing for them. And that positive signal can look different depending on what the type of business is. So that's where some of the subjectivity comes in. But there's a variety of activities we do to come up with ideas. There's everything that's as informal as a Slack channel where people are dumping stuff in. There's everything as formal as every 2 weeks we assign some reading on a sector that we're interested in. We have an ideation session that has a rigid format and some custom software we've built where we grade ideas from 1 to 10 after a pitch and have a moderated discussion on them and stack rank them and then decide what to work on. I would say none of that is necessary to run a good studio, but we found that having both a structured set of ways we come up with ideas and an unstructured way of coming up with ideas, both are helpful. And we've had startups come from both of them. The most useful unstructured way of coming up with ideas is having relationships with lots of great entrepreneurs who will email you or call you or go to drinks with you when they have an interesting idea. And they're like, have you thought about this? And you're like, ooh, yeah, come work on that thing with us. Like that is actually the thing that works the best. But all of the other stuff is really great to sort of keep that momentum going. I don't think I totally answered your question on like, how do we decide whether to put an engineer on a project or pull them off any given week? But I think that is a little bit less interesting than a lot of that other stuff.
Yeah, you took it in a more interesting direction. I wanted to kind of transition a little bit to talking about the podcast and how that's kind of influenced your thinking as an investor. And so I guess for context, when I like pitch Acquired to my friends, I'm like, you should check out this podcast. I'm like, these guys rock. They deep dive these companies, find anything that can be found, tell the story in like a really compelling narrative, read their filings, like all that stuff. And I'm just really interested to hear what your creative and research process is when you're kind of approaching such a big endeavor. Like, how do you split up that work? And then I guess like, how has that thinking maybe impacted the way you evaluate companies, if at all?
Yeah, great question. So the first thing I should say is Acquired started as a complete hobby project and just something I was excited to do because it felt like a fun thing that I could put on the internet. I would say like since I was 15, what I've liked to do is make stuff that feels well constrained and able to articulate it in an easy way and put it on the internet. And so that used to be apps.
Conceptually is equity, right? But let's talk about
actually quite an interesting concept.
Assets and liabilities.
Jessica, sorry, can you mute yourself?
There are a group of people who
there we go.
all were part of this company, if that makes any sense. Like for very large companies, you'll have like thousands of like owners.
There we go. Okay, sorry, continue.
Equity is just a construct, man. So, okay, so like Acquired happened to be this thing where it was like, I made apps, I used to write blog posts. Now it's like, here's a well-scoped thing that I can make and polish and put in a box and put on the internet. And like, it has turned into this like whole beast of its own, where like, I never intended it to be like top of funnel for my venture fund. And I never intended for it to become like a media brand. It was like, I want to make a podcast where like, I figure out what the things are that make acquisitions successful and what the things are that completely torpedo them. And as you mentioned, it's like turned into this thing where like now we just do like the deepest, craziest research on companies to try and come up with like, what is the canonical story and through line of this company? If you really wanted to understand it, how would you do that? Both through its history and through analyzing it from a business perspective. It's sort of like a poor man's Wall Street analyst. And I mean, you're going to laugh, but the place that I start is Wikipedia. Like every single time, I think David and I both start on like, well, let's read the Wikipedia article for the company. And we kind of spider out from there. David goes heavier into the history and facts, and I go heavier into the financials of the company. So I'll, go to the SEC site. I'll go to the company's investor portal if it's a public company. We try and read every if there's a book on the company, we'll read a book. We'll try and read every piece that's been written on the company over the years, if it was like a monumental piece. So a lot of times, we're not going to read the five paragraph Bloomberg article, but if somebody goes and does like a thought piece on the company, from 2012, it's really interesting for us to read that because in part, I think the most interesting thing about these episodes is understanding what the company thought they were and what the narrative around the company was at different points in time, because we kind of forget that and replace all that with what have people said in the last month about this company. So there's this interesting bit of sort of nostalgia that helps you understand. And the nostalgia will show up in their financial statements. That's the craziest thing, is like you can see older revenue lines, or you can see where gross margin shifted, or you can see where they had a big G&A fixed costs spin up because they went heavy into hiring after they learned this about the market, and then they went and raised that venture round. So it's always interesting to me to tie the like more narrative components of the company with how it shows up in the numbers in that business. And that wasn't something that I realized you could really do until I started doing Acquired. Like to me, as someone who studied CS in undergrad, finance was boring, and finance was like, well, I'm sure there's an accountant that can handle that at some point. And the notion of strategic finance didn't really occur to me. And I think the thing about Acquired that really opened my eyes was like the business's financials do tell the same story, just in a much granular way than a prose version of the history of that company. And that's just been an interesting sort of insight to me. So to answer your question on sources, it's reading Wikipedia, it's spidering out from there. I love looking at Quora answers of why did this company do that thing? I think that always provides interesting color. I love going to YouTube and watching interesting like talks by the founder of that company over the years, especially if it's at like, for the SpaceX episode, watching Gwynne Shotwell, who's the president, give like pretty small room presentations at like rocket industry conferences, because she'll say stuff that is like not the things that, you know, Axios is reporting about Elon. But it's like very interesting things about why the company is doing what it's doing. And so I always look for stuff like that that is more publicly available than you think it's going to be. And then lastly, my favorite thing to do for any episode is network my way to a person who works or worked at the company and ask two questions. One is, what's your favorite story that you think is undertold about the company? And you don't have to tell me anything, you know, that I shouldn't know, but like if it's especially if it's harmless, like it's fun to get a novel story about the company out there. And the other one is, what do you think is the through line that is the interesting story of the company? Like what would people be remiss not to understand about the company if they really were getting, if this was the one thing they got to consume about this organization? And those two questions always yield just amazing and different responses from people that become a part of our research.
Wow. Okay. Those are two great questions. I guess kind of a corollary to the first question is, another thing that I really respect and admire about Acquired is the ability you can turn large qualitative questions, like what are the top 10 acquisitions of all time, into something that is quantitative. And I get that, like, of course, there are problems with putting numbers on those things, but I always find the way you explain the model you've created to be really elegant. And I was just wondering, when you're kind of faced with such a big question like that over a massive time scale, and you're trying to assign like numerical weights to qualitative things, what does that process look like? And I guess same second question, which is, has that been portable to the way you evaluate companies and kind of more the VC portion of what you do?
Yeah. Well, I don't know if everybody is this way, but I can only really know what I'm thinking by talking it out. And so having David as like a partner is incredible. Like having someone brilliant who can sort of talk through a very ambiguous problem like that with me is like, I think that's where the magic, the fact that someone like you, it would reach someone like you, and you would eventually say that, you know, you find it, I can't remember the words you just used, but that you find it interesting the way that we're able to sort of get to the core thing of like, how do you decide to analyze this thing? Like that's just magic between a partnership. And I find that that's the same way in Acquired as it is when we're evaluating companies, like talking through with my partner, Julie, for example, with an investment that we're looking at. It's the same process of starting by just kind of talking, like with the Acquired top 10, you know, it was like, okay, well, how would we evaluate the top 10 acquisitions of all time? You could do it by IRR. Is that interesting? What does it actually tell you? If you're sort of, no, I think actually more interesting is if you look at, I can't remember what the second step in our logic was. Maybe it was like, what's the cash on cash multiple? Like maybe that's the most interesting thing, because if someone's wondering really like, what's the best acquisition of all time? What question are they really asking? And then we were like, well, but that can kind of be, is actually the most interesting thing here is like the absolute dollar return, because, you know, you shouldn't have something be penalized if it was bought for 30 billion, but became worth, you know, 800 billion. Like that's the fact that they bought it for 30 billion shouldn't penalize them. So in order to create what we think people really mean when they're asking the question of what is the best acquisitions of all time, we sort of, it's arbitrary, but decided that our metric was what was the absolute dollar return from the cash someone spent to get that asset in order to turn it into the massive amount of market cap contribution that it is today. And as that translates to an investment context, we totally do the same thing, where it's like, you get into like a round table and you're like, okay, well, I mean, what did we think of the pitch? Or what do you think of this company? And then there's a conversation that sort of happens that's like, okay, well, what do you need to believe about this company in order for it to be, you know, $100 million revenue company at some point, someday? And that leads you down this direction of getting more granular, and you can kind of drive to like, okay, there really are like 2 or 3 things that we would have to believe, 3 numbers that have to multiply together to be $100 million. So like, let's talk to the entrepreneur in the next pitch about those 3 very incisive things. And I can't underscore enough that I think it's like really good conversations with smart people who are driving for the same outcome.
Seems like your model got it right, because people in the chat seem to agree with your assessment that Instagram was in fact the best acquisition of all time. So for those of you who said that, you should definitely listen to that episode. So I know we're kind of coming up on the end of my time with you. I kind of wanted to close out with some questions about the public markets, because I know that there's a lot going on and a lot of those concepts are touched on in your podcast. So I guess my first question is, given all the stuff that's going on with SPACs and direct listings, and you had Eric Ries on your podcast and he talked about the long-term stock exchange, and I thought that discussion was fascinating. Just wondering if you had any kind of big picture perspective on where you think the public markets are going, what types of things are exciting you, and what you think we should kind of keep our eyes on.
Well, the first thing I'll say is the explosion in innovation of a bunch of people taking a bunch of different directions on the same problem over the last 10 years and all coming to fruition in the last 12 months is awesome. Like, there's been this general problem that the IPO is pretty broken. It's expensive, it leaves money on the table for existing shareholders. It's a brutal process for a company to go through. In some ways it's great because it forces you to be really buttoned up, but it's brutal. The people who are investing aren't necessarily your long-term shareholders. You get this mix between the people who are creating signal around your price, or the shortest term holders, and the people that are actually buying the biggest chunks of your company aren't creating any signal around price in your market because they're not selling. So there's all these sort of like pieces of going public that are kind of messed up. You don't know who your shareholders are. When you're a private company, like, I know every single name of every single person on my cap table. So weird, I go public and now I don't know any of them and they could do some corporate takeover. Like, it's crazy. So I love that SPACs happening in the last 2 years, Barry McCarthy pioneering the direct listing, which Shopify and Slack did, more recently Palantir, and someone may know the other company that IPO'd the same day and also did a direct listing. And also there's a new innovation in the New York Stock Exchange by something that got approved by the SEC, where you can do a direct listing and simultaneously raise capital at the same time, because that's been a limitation of the direct listing, that if you just decide, okay, we're going to be publicly traded, but we're not raising any capital, well, most companies need to actually have a financing event by going public, not just allow for, they need to raise new cash on their balance sheet, not just allow for people to just start trading the stock independent of that. So that's a cool innovation. The long-term stock exchange, this is like amazing and quite, I mean, it's a crazy idea that is very different than a lot of our system. And one crazy insight is that you can actually vest into your control provisions. And that was a lot of jargon. So what that really means is the longer you hold your stock, the more say you will have in voting for things that come up in the company. I'm sure any of you guys that hold or women that hold Tesla stock or whatever stock you hold, you get these sort of proxy statements and invitation to come and vote at the shareholder meeting. It's like, I just bought it yesterday. Why should I get a vote? And so there's a lot of innovations that the LTSE is doing that I think are really interesting and just different than the way that these systems have worked for the last 100 years. And so I'm just excited that with all these different options, it means that there's a competitive market for how founders can solve the problems that they're trying to solve by going public in a way that, because there's competition, these companies can actually get the best deal for their shareholders, for their employees. Like, they can go through it in a less painful way. It's like the company having leverage over our financial system instead of the financial system, and really like 3 to 5 banks having leverage over every company that wants to IPO. So it feels like it's a really good time to be a late stage private company, because you finally have this nice buffet of options in front of you that theoretically you can pick the right option for you, and it should be less expensive than it was in the past.
The last question I wanted to ask before I open it up to other people who I'm sure have questions is, recommendations you have. So I guess the first part of the question is just like, what things do you read? What things do you listen to that you think have just been kind of formative in your understanding and kind of passion for VC? And then the second one is, for those of us who, or not us, but for people who have not listened to your podcast yet, kind of what episodes are you most proud of that you think they should start with?
That last one's easy, so I'll do that. The SpaceX episode was just mind-blowingly fun to do. Disney Plus was also very fun to do because we got to talk about all the different big landmark acquisitions that painted all of our childhoods that came together to make this possible. Lucasfilm, Pixar, Marvel. The history of Disney is just a fascinating company on its own. So those are both really fun ones. Your question around sort of my media diet, are most folks here in undergrad?
It's a mix.
Okay.
Yeah.
This applies for everyone, but there's this, so Mark Andreessen, before he started Andreessen Horowitz, he wrote a blog that was, I think, pmarka.com, which is, or Pamarka, or I've never known exactly how to say it, but someone took that old blog that he wrote in the early 2000s and made this, it's pmarchive.org. It's an archive of his old writings. And he wrote this thing that I think is still the best resource on career planning called the Guide to Career Planning. And it is, if you are an ambitious person who thinks either entrepreneurially, or you just want to like go have a fun, successful career where you work your ass off and like you make something awesome with other really smart people, I think there's literally no better resource that you can order like on the internet, on the book, whatever, and read. So I highly recommend making the hour or two of time and reading that, especially for where folks are in their career. In terms of what I read that I think has shaped my thinking, I can't stress enough how good Ben Thompson is. I mean, lots of you probably already read Stratechery, but just super enlightening. And I think like he doesn't get enough credit for it, but like aggregation theory is on par with Porter's 5 forces in terms of like really important business frameworks, especially to understand internet businesses, which are, I mean, just look at the market caps of the top 5 10 companies, like that is the dominant business model of our time. So Ben Thompson, I love the interviews that Patrick O'Shaughnessy does on the Invest Like the Best podcast. It's not just investors anymore. He has founders, operators on, and he's just such a incisive interviewer. Like the way David and I do interviews is we put our own flavor there. Like the guest is there, but like we're not just interviewing them, we're also talking ourselves. Patrick asks a really interesting question and then shuts up. And like he'll do that with Fortune 500 CEOs, hedge fund investors. Like it's just very, very good. So you could do way worse than listening to the Invest Like the Best podcast. You know, you're all at Harvard, so I'm sure you have lots of access to HBR stuff. But I mentioned Porter earlier, Competitive Strategy, just the original like journal publication, it's like 20 pages or something, is so good. Like, I think I waited way too long in my career to read that. These are like business frameworks. If you like symbolic like notation and like more economics type representation of business concepts, 7 Powers is an amazing book by Hamilton Helmer. We recently had Hamilton on our show to talk about it. I think there's lots of these like business framework books. I think his does the best job of replacing all the other ones, and you can kind of just read 7 Powers and be done. Not totally done, but it's, yeah. So I like that one. I don't know. It's just those are more on sort of the like business frameworky side, but
no, those are fantastic. Those are all super insightful. So I'm going to give other people opportunities to ask questions. So if you have a question, please raise your hand and I'll call on you and try to spotlight you. And yeah. So it seems like Claire has the first question if you want to ask.
All right. So while doing Acquired and of course PSL, I'm sure you get a number of surprises when you kind of poke around and you ask people about those undertold tales and those through lines, and kind of along the lines of the undertold tales. What do you think is one of the biggest surprises that you faced when you poke around and look a little deeper at different companies?
Actually, how hard it is to get a question of the through line if somebody has spent a good chunk of their career at that company. I think for those of you who haven't worked at a company yet, haven't sort of started your career, it is amazing how easy it is to get the blinders on, where it's actually difficult to articulate what you do at the company after a certain period of time. People will say like, okay, I'm brushing up my resume and I'm getting ready to go to my next thing. I don't, especially if it's a startup where there's like very ambiguous job titles, I don't know what I do. I don't know what I'm good at. I don't know what transferable skills I have. I think there's this interesting thing where like, both for that use case and the use case of what's interesting about your company, people just can get so myopic about their own responsibility there that unless you're talking to an executive or a founder, they often don't sort of like pick their head up and look around the landscape enough to be able to have a thoughtful response to that, absent a little bit of coaching. So I often will get the comment back first of like, I don't really know. And I'm like, well, the media has sort of talked about it this way, but then there have been other companies that have kind of competed more. And in the old world, you know, back when the company started, it was kind of this way. What do you think about all that? And then it takes that framing to like shake them out of the, you know, day to day and actually be able to, but usually I do get a good answer after that. It just takes a little bit of a head shake first.
Gotcha. Thanks.
Yeah. Does anyone else have any questions? I have some that I'm dying to ask, but if you raise your hand, I can call on you.
I do have another question, almost like a follow-up. Well, so looking at all these different prominent companies, how has doing acquired for the last 5 years changed how you see the VC and startup space specifically?
I have two answers to that. One is personal and one is reflecting on the landscape. From a personal perspective, it's amazing how everything is kind of a media business. Like in VC, the way you make money is hopefully the way you make money is making great investments and getting carried interest on those investments. The way lots of VCs make more money is on the fees on managing the capital that they've raised. To me, that's a business model, especially where we're evolving now. That's a business model on top of media businesses, because this asset class of VC has become so popular that capital requires a lot of branding around it to be successful, because capital is pretty commoditized for startups. Lots of people are trying to put money into startups, and it's not evenly distributed, and we have lots of work to do there, like massive diversity issues of actually who gets the capital. But like, let's say you're a 5-year veteran of Stripe senior product manager, like you will have a line of people waiting to fund your thing. And so it's doing Acquired and you know, building this community that we've built with Acquired, the Slack, and just the reach that it has as a media brand at this point. It's been amazing to me, the impact that it has on my ability to see some of the most interesting companies that are pitching for early stage capital, and their willingness to take that capital because I'm like a person that they know of. And like, you compare that to venture capital, like in 1970, like that's not how Don Valentine and Sequoia were at that point, because that asset class it was scarce. Like capital was not plentiful. And so all the leverage was with the capital allocator deciding where to put it. And so as asset managers and VC get more and more squeezed from both sides and it becomes more and more of a commodity, media has been this interesting way to stand out as a business. I will say on the broader landscape, if I were an undergrad right now deciding if I was going to go into VC, it kind of feels like 1992 deciding to go into hedge funds, where like, not that the party's over, but like the early rush has created the need to be very differentiated in order to avoid your competitive edge being arbitraged away. And like, I do sort of wonder what the next frontier is. Like, let's say it's 1993, where's the next venture capital? Not where's the next Wall Street? And I'd be curious to hear sort of your thoughts on it, because I don't really have one, other than I do feel like it's a relatively mature asset class with a lot of players at this point.
That's fascinating. I think Aiden was the next to raise his hand.
Thank you so much for talking. I'm a big fan of Acquired, mostly because Roman plugged it to me this summer. So you touched on this and you mentioned kind of looking at the narrative of a company changing over time. And I was wondering if you could talk a little bit more about how rare it is for a narrative to stay constant, or whether, you know, people get it right most of the time when they start up.
Well, 100% of the time, narrative of how the outside world perceives a company is different than how the company is actually doing what they're doing. And I know this way less actually from Acquired and way more from starting companies and being really close with a lot of founders. Like, companies are a gigantic effing mess almost all the time. And I think that's true like pretty late. Like, I think that's true after companies IPO. And you know, at some point you hire actual PR people and they always make it seem like things are more methodical than you would think, even for these amazing companies, right? Like, the narrative around, wow, Netflix grows 30% every quarter. They must have it all so buttoned up and just be amazing at like creating the machine here. They're not. Like, you talk to people at Netflix and they're like, everything's on fire all the time. Like, all the systems are always on fire. And it's like, by the skin of our teeth, we managed to grow 30% quarter over quarter, or year over year. And so I always try and remind myself that when I'm doing an Acquired episode, because just all my firsthand interactions with companies are like 0% of the time the public perception has matched what's going on inside the company. And that's true at the early stages too. I mean, it creates this, I'm sure many of you have been founders. It sucks going to a networking event and like your company's going terribly and someone says, how's it going? And you're like, great. And like that, it starts there. That's the moment where the narratives start to diverge. And it doesn't take a PR team. It just takes the sort of incentive of wanting the outside world to feel that something's a cohesive story, but inside it's crazy town. And we all index on the stories that get told. There's a survivorship bias of the stories like Instagram. And like, I think we way underweight how rare those are. Like, we hear they're rare and we're like, oh, that's like 1 in 100 startups. It's like 1 in 10,000 startups. Like, nobody should be paying attention to those to pattern match off of, because that's not how it goes. That, like, odds are against you'll ever be involved in something like that. So unless you're building a big portfolio, that's why venture funds want 30, 40 companies in any given portfolio. Employees don't do that. Founders don't do that. They're getting one. So we should be indexing off of stories from the middle of the curve, not these insane outliers on the power law curve, for which we draw the lessons.
Michael?
Yeah, so I actually have a thought about what you said just a few minutes ago about like what's the next stage in venture. And I think Chamath has a really interesting thought about this. If he's bringing back SPACs, which is, for those of you who don't know what that is, it's a special purchase agreement for for a company to basically go IPO without going through the whole very time-consuming and expensive process of IPOing. And it's a concept that he's building around is you basically group together a bunch of startups who have very similar types of goals or working on very similar projects, and you basically make a company or like a SPAC out of those, and you fund it basically from day one until it IPOs into the SPAC basically. And it's a way to take a much longer horizon view of what the whole process is, because it's the biggest companies that exist today, like it's Facebook and stuff. I mean, those have been, Facebook is now what, 15 years old or more actually, and people still talk about it as if it's just like a company that only been around for 6 or 7 years, which is oftentimes not the case. There's this huge time shift bias, I think. And I wanted to get your thought kind of on how are the early stage investors sort of adjusting their expectation for companies that may not have a definable exit. And it's not necessarily in the point of like consumer applications as products, but like well-defined its business structure ventures that are entering markets that don't have a very well-defined exit, like a space.
Yeah. Well, if you look at percentage of exits from venture in like the 60s, 70s, and 80s, IPOs were at an all-time high and acquisitions were at an all-time low. And basically every year until, I don't know when the last time I looked at data, 2017 or something, exits are increasingly acquisitions and less IPOs. The thing that's exciting about this right now is like, there's lots of ways to IPO and there's lots of ways to IPO earlier. And so, or be a public company earlier, which is good for everyone. And even at a democratic level, it's just good for the American public that retail investors can have access to buy into these very innovative companies at a lower price, not after all the growth is gone, which we saw with Uber and some of these other companies. I think your question was around how do early stage investors think about an exit potential. Is that right?
Yeah. It's more from the standpoint of companies that may not necessarily need extensive follow-on investment, or are in markets where a customer, for example, or a large partner wouldn't necessarily have the financial capabilities or the ability to pay an acceptable multiple for access to the customer base.
Look, with it being easier to be a public company sooner, I think that at least, and everybody's different on this, like at least the way I think about this is, if a company has the opportunity to be a relatively high gross margin business that is a high growth company, and I can see a path 5 to 7 years from now, like a path to them being $100 million revenue business, then like, I don't really care their exit strategy. Like if I get to own a material piece of a high growth, high revenue, high gross margin business, awesome. Like they will find a way to generate a return to be on that. I think the canonical wisdom about 10 years ago was like, who's going to buy you? And that is, I wouldn't say going away by any means, because it's still an important question, but no longer a showstopper.
I'm curious to know also on sort of the way different investment vehicles are like taking shape. You're starting to see more commonly accepted, I guess I'll call them like derivatives of venture investing, things like safes, which are effectively futures, or like different crowdfunding agreements and things like that. And I guess my general concern, or I mean, just point that I want to bring attention to is these deals are getting like much more complicated, and there's all these like different structures that are hedged on not even like profits, but either revenue or like punts on unit economics and things like that. And we're seeing even post IPO companies still being like net negative. So is this like a scenario that could turn into like a bubble or like real estate type 2008 scenario, or is this like different in some way?
Bunch of different questions in there. The one that I definitely want to address is it's different than 99 because those companies didn't have any revenues. These companies don't have profits, but at least they have revenues. And now I'll speak up to about 2019. There are some companies that are like enormously profitable SaaS companies out there right now that like, I think you look at, actually Twilio may not be, but Zoom and some of these others. like we have seen a return of very profitable public companies for a while there, and it's still happening. To me, it was almost like the same way that you raise your seed round on a story instead of your numbers. It felt a lot like people were going public on a story instead of their numbers, which seems dangerous to me. But in almost every single one of those situations, at least there was big revenues. So we're okay there. And their unit economics were strong, even if the fact that their growth or them competing with other people were causing them to not be sort of profitable on an EBITDA basis. I still don't see how Uber's ride sharing business ever becomes unit profitable. But I think like hopefully that's the exception and not the rule. And we've sort of we've had a coronavirus inflicted softer correction instead of the need to have a bubble burst.
Okay, I think that's a great place to leave it. Thank you so much, Ben, for all your time. This has been absolutely fascinating. I think I can speak for all of us and our gratefulness for you having come here. And if any of you would like to hear more of Ben's wisdom, I really encourage you to listen to the podcast. It will not disappoint. Aiden can confirm. and yeah, thank you all for coming.
Nice to meet everyone.
Hey, Ben.
Thank you.
Is there a good way to get in contact with you after?